If you've been following the news lately, you've probably heard the warnings. Artificial intelligence is in a massive bubble, valuations are insane, and a crash is coming. With AI stocks now making up a significant percentage of popular indexes like the S&P 500, it's completely understandable if you're currently feeling worried. We're even hearing more and more comparisons to the dot-com crash in the year 2000, with some saying the situation is even worse compared to then. So, let's explore if we are indeed in bubble territory, what that means for passive ETF investors like my wife and I, and how we're navigating the current economic environment with our investments, which clearly have already started suffering over the past month. Are things likely to get worse and is now the time to sell and realize some profits? We'll see. If you're new here, my name is Angelo, and I've been investing in local ETFs for over 8 years together with my wife in pursuit of early retirement in Europe. Alright, so let's start with the evidence that we're in a bubble. When you just look at the numbers, it's understandable to feel a bit concerned. Did any of you notice how large the top 10 in the S&P 500 have gotten lately? The largest 10 stocks now make up almost 40% of the entire index, and most of them are heavily exposed to AI. So 10 stocks currently account for 40% of the S&P 500's value, with the other 490 companies making up the remaining 60%. That's pretty wild. Nvidia alone makes up 8% of the entire index. To put that in perspective, Nvidia's market cap is now larger than the 20 biggest companies in Europe combined. And it's not just a concentration that has people worried. A recent Bank of America survey found that 54% of fund managers believe AI is currently in a bubble, and that 60% say stocks are overvalued right now. Even major institutions like the IMF and the Bank of England have issued warnings about a potential sharp market correction due to stretched AI valuations. And Michael Burry, who famously predicted the 2008 housing crisis, has actively been shorting Nvidia and Palantir lately, believing they're overvalued. Now, to be fair, he's been wrong far more often than he's been right the past few decades, so take that with a grain of salt. On the surface, comparisons to the dot-com bubble seem compelling. Back in the year 2000, the market was heavily concentrated in tech stocks with sky-high valuations. So is history about to repeat itself? Well, here's where I think the comparison starts to break down. There's a fundamental difference between now and the year 2000 that most people seem to overlook. The dot-com bubble was filled with companies like Pets.com that were making no money whatsoever. They had flashy websites and big promises, but no path to profitability. Today's AI race is completely different. Companies like Nvidia aren't just hyped up startups. They're making unbelievable amounts of money and have been beating earnings expectations quarter after quarter. Just a few days ago, Nvidia once again reported earnings that beat analysts' expectations. But here's what happened this time. Despite these incredible results, the stock still sold off. To me, that tells you something important about market psychology right now. People are so nervous and looking for any reason to sell after a strong rally we've seen since April that even better than expected earnings can't satisfy them. Now, will Nvidia and other AI companies always beat expectations? Of course not. But right now, demand for Nvidia's chips is still far outpacing what they're able to produce, which is why Morningstar analysts are still considering the largest company in the world to be undervalued. I don't see this trend stopping just yet. Obviously, all of these massive investments into Nvidia chips and AI infrastructure need to translate into proportionally higher profits down the line for the companies making these investments. That still remains to be seen, and it's a valid concern. But I remain optimistic that this is going to play out, as we're already seeing real-world applications of AI driving actual business value, with more and more companies implementing artificial intelligence in some form. Yes, valuations are elevated compared to historical averages. But here's what most people miss according to Duality research. You can't compare today's valuations to the dot-com era on a basic price-to-earnings basis, as that assumes the index earnings structure and risk profile hasn't changed over the years, which is not the case, especially considering how much the sector mix in the S&P 500 has shifted. It all comes down to profitability. Profit margins are significantly higher today compared to the 10-year average. And since higher profitability demands a higher valuation premium, a profitability-adjusted price to earnings comes out to 17.75x, which is less than one standard deviation above the 20-year average. As a result, the authors conclude that if this is a bubble, it's probably the cheapest bubble in history. And here's something else to consider if you're a European investor like myself. If you're invested in a global ETF, like the FTSE World that I hold, the top 10 holdings make up around 24% of the index, far less than the 40% in the S&P 500. And while Nvidia on its own is still quite large at 4.7%, this is still nowhere near the 8% in the US market. So yes, we're seeing some concentration here as well, but the situation is nowhere near as extreme when you're holding a globally diversified portfolio. By the way, you can find my favorite low-cost brokers in Europe for ETFs and stocks down below in the description, which is a great way to support me if you'd like to. Alright, here's what my wife and I are doing with our portfolio right now. Our global ETFs are currently down close to 12,000 euros over the past month. So while I wouldn't call this a correction just yet, we're definitely noticing this dip in the market. As for our average yearly return since we started investing in 2017, that is now sitting at an average of 11.28% per year since then. So I don't see any reason to complain just yet. Even still, the past few weeks have started to resemble tariff madness we saw back in April, with people just waiting for any reason to panic and sell their stocks. Perhaps the market has rallied so strongly since the April lows that investors are simply looking for any excuse to take profits. Even Nvidia beating earnings expectations wasn't enough, the stock still sold off. We may indeed be correcting a bit here, which is completely normal and happens regularly, especially when the market runs up so fast in a short amount of time. But here's what I find really interesting. When you look at the CNN Fear and Greed Index, it's showing that investors are feeling extremely fearful right now. In fact, I'm not sure I've ever seen a reading that low before. And so-called bubbles don't burst when everyone is terrified. They burst when everyone is euphoric and can't imagine prices ever going down again. I'd argue we're very far from that. It actually feels like the opposite. Everyone seems to be worried about a market crash. So here's what I'm doing. As a passive long-term ETF investor covering stocks from the entire world, I don't see any reason to change my strategy. In fact, when looking back, this could turn out to be another great buying opportunity, which is exactly why I just bought a bit more of the accumulating Invesco FTSE World on Interactive Brokers in the morning. My wife and I are also keeping a recurring investment into that same ETF active at the start of each month, so nothing is changing on our end, as none of this changes our long-term outlook regarding the stock market. Now look, I completely understand if you're feeling worried right now. If you have a larger lump sum you were planning to invest, it's perfectly fine to dollar cost average, or rather euro cost average, into the market at regular intervals instead of investing it all at once. For example, you could spread it out over 3, 6 or 12 months if that helps you sleep better at night. And if holding 10 to 20% in cash on the sidelines, waiting for a deeper correction you're convinced is coming, makes you feel more comfortable, I see no problem with that either. But here's one thing I wouldn't do. I wouldn't let your emotions take over and suddenly abandon your long-term investing strategy. Whenever you're in doubt because of the latest news headline or a dip in the market, I find it useful to zoom out from the current price action and look at the long-term trend. While people are now concerned about the AI-related stocks being overvalued, there will be something else to worry about further down the line. There will always be a reason to sell if you're looking for it, just as there always has been in the past. And yet, the market has historically continued trending higher. Look, I can't tell you what's going to happen next. Maybe we'll see a deeper correction. Maybe this fear will pass in a few weeks and we'll look back wondering what everyone was so worried about. But if you're investing long term, so at least 5, ideally 10 years or more, then this short-term noise likely won't matter much in the long run. What I can tell you based on my own 8+ year experience investing in the stock market via ETFs is that I'm grateful I never let that influence my buy and hold investment strategy. Otherwise, we wouldn't be where we are today. A lot closer to our early retirement goal than we could have ever anticipated when we started working towards it in 2017. So once again, we're not changing anything. We'll continue putting our monthly savings into a single ETF and accumulating FTSE World. Regardless of whether the market is up, down or moving sideways, our strategy remains the same. You can find the links to my favorite European brokers for stocks and ETFs down below, which is a great way to support me as I don't do sponsors. Now, if you're wondering if the 4% rule for early retirement is still safe in the current economic environment, make sure you watch this video next. And as always, none of this was meant as financial advice. I'm just sharing my personal opinion based on my own experience as an investor. Thank you guys so much for watching. Have a wonderful day and until next time.